Is the stock market in a bubble? Controversy is erupting on X. Why Michael Burry describing the market in the last months of the 1999-2000 dot-com bubble. Can we detect a bubble? Let's dive in. Controversies come from this article by Michael Burry says the market today feels like the last months of the 1999-2000 bubble, and there has been some controversy on X saying, oh, look, this guy's a bit of a one-hit wonder, or people agreeing and people freaking out. But let's go in and say, are we in a bubble? Are bubbles detectable? Can we identify if we are in a bubble or not? And I think that we can, so let's dive in and see if we can detect a bubble. To introduce the concept of how I like to go about detecting bubbles in markets, I'm going to use gold. Now, this is the gold price in USD per ounce from 1965 to present. And what we can see is we had a few run-ups here, and of course, we've had our most recent run-up where price in the 1980s peaked up at around, I don't know, $700 or $800 an ounce. Then subsequently got to around 2000 in the early 2010s, and then we've come back up and finally broken out. But this has played out over 50, 60 years, and that's a long time to wait to see if you can try and achieve a bubble. But what we want to do is understand is everyone is aware that this 1980s was a bubble, but can we compare these other times to understand if they are comparable? And the answer is that we can. So how I go about detecting bubbles is I use the price adjusted for the broad money supply. So this is the same gold chart, but what we've done is we've adjusted the price of gold by dividing it by the US broad money supply, or M2, to understand where gold was the most insanely highly priced that it's ever been. And what we can see is in the 1980s, that little peak that we saw in the previous slide was actually a massive adjustment in terms of the price of gold on a money supply basis. And then we fell back down. And then in the 2010s, we kind of hit the peak of that, the sort of fair value channel. And then we brought back down. And then from December 2022 to May 2026, we have had us break through that fair value channel, and we're starting to look like we're in bubblish territory now. So that is how I think about bubbles. And we can apply this to other markets. So this is detecting the housing bubble in 2008. So this is the house price index for the New Zealand, US, UK, Australian, and Canadian residential property markets. And what we can see is them going up, 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 up. It's all up and to the right, right? Like a traditional market, like we've seen in all these other markets when we price them nominally in dollars or when we index those dollars. Now, this is 2008, which you can see like a little up and then it sort of peters out. But can we detect a bubble? Now, again, we adjust it for money supply and things become much more apparent. So now we have the house price index adjusted for M2 money supply in each economy, right? And we can see really clearly that in 2004 to 2008, we had these big peaks in pricing. So this is the US, this is New Zealand, this little yellow line is Australia, and this big red one is the United Kingdom, right? And we can see clearly that these all get pronounced during that 2004 to 2008 period where interest rates have gone really, really low post the sort of the 2000 dot-com bubble crash. And then we've seen subsequently that their adjustment for money supply has weakened. And so we're pretty clear that they're not in a bubble anymore. And what you can see is actually when you adjust for money supply, houses aren't getting more expensive. They're in fact getting cheaper when comparing them to a fixed basket of money. Applying the logic to US stock market. So we've got these three major indices in the US. We've got the NASDAQ, we've got the S&P 500, and we've got the Dow Jones Industrial Average. And what we can see is it's up and to the right, like every market that we've traditionally looked at. But again, things look very different when we adjust for money supply. Again, here is the US stock markets, the NASDAQ, S&P 500, Dow Jones Industrial Average, adjusted for money supply. And things become a lot clearer. Now, what is really interesting is we have the dot-com bubble here. So we have the NASDAQ shooting right up on a money-adjusted basis to very, very high volumes. These graphs have been adjusted to 100 for the starting date, just so they sort of appear at the same level. And we can see that the S&P and the Dow Jones Industrial Average were sort of at this level when adjusted for money supply. And then we sort of come down. We've had the GFC again, and things have now come back up. And what we can see is the NASDAQ is now at a very similar level to what it was at the dot-com bubble. You could argue it's higher, which is very, very intriguing. And we have the S&P 500 and the Dow Jones Industrial Average at levels very, very similar to what they were in the 1999-2000 bubble crash. So that is fascinating, right? You can see a clear trend for like why you would say Michael Burry might be onto something in saying what he has said, that we are feeling like we're in the 2000s, because on a money adjusted basis, that is correct. This gives a lot of credence to what Michael Burry is saying, and so I have a lot of respect for what he's said here. But what I think we want to do is we need to understand that things are slightly different. So what has changed? So obviously prior to here, we didn't have the internet, and then we've had this big rise up, and we can see a sort of a structural shift, higher level in the USD pricing, or the pricing of the NASDAQ relative to the value of the US dollar in this area, and then we've sort of had a rise up. Now, what to me that states is we've had a structural increase in the value of the NASDAQ given what it's doing, right? The tech industry was a massive instigator of productivity, and so it went and attracted far more of the money supply. So that to me makes sense. And we could see a shift up in the NASDAQ as a result of AI. And I think that's a really credible thing for us to analyze, right? I think that AI could shift this value up again another level. And what we need to understand is, like, do we think this has gone to a level that is a fair, appropriate approximation of what that value is? And that's really hard to understand, because the tech boom was massive. It introduced a tremendous amount of efficiency into the economy, but AI will do way more than that, right? It's going to be a mega trend. And so the market has yet to figure out how to price that. And what we'll see afterwards is it come back into a range that we feel is reflective of the addressable market of AI, which to me is where the question lies. Is this reflective of the addressable market of AI, and things could go up, continue up to the right? Or it's not, it's overvalued, and we are in a bubble, and things are going to come down. And then, of course, we need to ask the same question of the S&P 500, Dow Jones Industrial Average. Are they doing things that are structurally more productive and more powerful and attracting more money supply as a result of what they've been doing over the last 25 years compared to what they were doing here? Or are they not, and they are overvalued? These are the questions. But you can see clearly that there is a very good credence to what Michael Burry has said. So other cool stuff that we're going to discuss in this episode. So I've added real-time strategy performance tracking to my strategies, which is great. So I got sick of manually calculating them in Excel. And in each video, we're going to compare the performance of my strategies versus buy and holds and various other strategies to get an understanding of like the value of what we're doing. And this is currently a faceless channel, but finally I might in fact be getting a face. I'm trying to do some facial expression performance so that you guys will see a face to the Mangosteen, and we'll bring him to life, which will be basically my face presented through a digital filter, which will be quite cool. Bitcoin has been doing really, really well. We've had our bullish flag, which we entered at around the 72K mark, and we're now trending into the 81, 82K zone, which is great. Everything is looking great. And Mangosteen Original has now performed at around a 69% return for the last 12 months, compared with around a negative 21% return for a buy and hold Bitcoin strategy, right? So fantastic result overall. And this is what I mean by adding this like real-time performance tracking. It makes my life way easier and allows me to communicate the value of what we're doing much, much more powerfully. So we've come into short and long-term probabilities that are much lower and in line with a bear market peak. So if we're going to peak in this bear market and come back down, we are approximately at that range around here where that may in fact happen. However, we do have some strong stories. We've had this growth in price appreciation from the 75 to the 82K range, driven primarily by increasing open interest. Now, the interesting thing is we've had that relax over the last few days with the buying come up and restore, and obviously people haven't come in to sell on the spot market, and the spot buying has been able to push the price up quite comfortably anyway. And so there still seems to be a fair view of robust demand for Bitcoin at the moment. On MicroStrategy, so obviously we came into MicroStrategy at around the 130 dollars per share level, and we've come up to the 187. So we've ridden that really nicely. We've either been balanced into MSTY or we've been long, and we can see that I've added the various strategies that we could be using in order to leverage this strategy, and we can see that I have outperformed the general buy and hold strategies massively. So if you were in MicroStrategy, we would be down 55%, which is not ideal. If you are holding MSTY, you'd be down about 37%. If you held Winter through the spread, you'd be up about 40, which is good. And obviously STRC, which is our new entrant, would be at its typical 11.5% dividend income. But Mangosteen strategies, if you were doing this on a unlevered long-short approach, you would have been up about 160%, which would be lovely. If you were doing MSTY winter rebalancing, your effective yield would be something around 85 to 90%, which is yum. Like, that is phenomenal. That's like retiring on a few $100,000 of capital, sort of very comfortably. And of course, if we were doing rebalancing between MicroStrategy and STRC, so obviously if we're in MicroStrategy when things were going up, but we just sat there and held STRC and enjoyed the income throughout that last 12 months, assuming STRC existed that whole time, we would have made around 34%, which is great. So this gives us a real-time view of returns for various strategies and how you can use these indicators in ways that are really, really powerful for you. So it's cool. Tell me if you found this content interesting. I really have traditionally taken a step back from some of the macro stuff and have been focusing on my indicators a bit. So if you've really enjoyed understanding how I think about macro bubbles and pricing of stock markets and stuff like that as well, leave a comment, because I'm really interested to know what you guys think. If you think my approach is bogus as well, if you've got a better idea, let me know. I'm curious to see what you think. And obviously, subscribe. Those likes and comments and things do really, really boost the algorithm and give me way more exposure. So if you think this is valuable for other people, then please do that as well. If you're wondering who I am just a humble Mangosteen with a background in finance, economics, accounting, and engineering, and professional experience across corporate strategy, finance, including time as head of investment and treasury for a multi-billion-dollar corporate. And I want to cultivate the next generation of active investors from suits to steel caps to renegade financial education and strategy. If you've liked what you've seen here and you think the tools that I'm using are really, really powerful, which I obviously believe that they are, you can acquire a 2-year license at the moment through Mangosteen Private. Check out my website, mangosteen.global. There's a 5% discount when you pay in Bitcoin, and there's obviously a 14-day no questions asked refund policy. So if you buy it and you decide it's not for you, then feel free to email me and I will refund you, no worries. And disclaimer, this channel does not provide financial advice or any advice of any kind. Everything is for general information or entertainment purposes only. It does not consider your personal objectives, financial situations, or needs. Reference to any financial products are factual only and do not constitute recommendations. You must do your own research. Any investment or trading decisions you make are entirely your own. This is entertainment only. You are listening to a random Mangosteen on the internet.